Hello guys, Dividend Enjoyer here, and today I'm going to be doing a stock analysis video on Energy Transfer, ticker symbol ET. I've done a couple of stock analysis videos on Energy Transfer, specifically because it used to be the biggest position in my portfolio. Full disclosure, I do not own Energy Transfer at the moment, so this is a completely unbiased stock analysis. I have nothing to gain because I've already made like $5,600 from this stock, and I was buying it at about $11.50 a share. Why did I sell? Why, what do I think the stock is worth? Do I think it's a good bargain? Let's get into it. So Energy Transfer currently trades for $17.33. It's up 5.8% over the past year. Currently has a market cap of $59.47 billion, a price to earnings ratio of 13.05, and an annual dividend yield of 7.56%. There's a 52-week high of 21.45 and a 52-week low of 14.60. So you could see that we're closer to that 52-week low. You're getting a really good yield here. So what gives? Why are you getting such a good yield on a company like this? Well, this company is primarily a pipeline natural gas kind of logistical company. So they own a lot of the pipeline infrastructure under the ground, and they essentially are able to charge their customers a toll to move natural gas through their pipeline system. So it's a really good business, and I think it's going to be really important as we see kind of the need for energy in the AI space and the demand for natural gas as a whole. But the reason this stock has been hit so hard, and kind of the reason, there's kind of a different reason that I sold, but the reason this stock in particular has been hit so hard is because they have a lot of their pipelines going into Canada. This has been an industry that has just been hit so hard by the Canadians in terms of tariffs. It's been a strategically kind of targeted company, and you could kind of see that in the revenue decreasing, the cash flows decreasing. So this is a stock that you want to own if you think that the tariffs are going to cool down with Canada, or if you're willing to hold this stock through the Trump presidency and get to hopefully a new candidate who's more friendly with Canada. It really just depends on what you kind of want to do. I really enjoyed this stock when I had it. I made a lot of money off of it. Like I said, I made about $5,600. It's the biggest gain out of any company I've ever held, and it was the longest company I ever held. But the reason I decided to sell it is because there's a special tax form you have to do every single year, and it just got to be a huge pain in the butt, and I was up a lot of money, and I didn't really want to be on that brokerage anymore. So I fully liquidated the stock and realized all of my gains, and I'm pretty glad that I did that. But I still think the company is very strong, and I think that if you have a long-term perspective and you don't mind filing that special tax form because it is a LP unit, it's not an actual share, then I don't think you're going to have any problem buying this stock and holding it for the long term like I did. For reference, I was holding it since about 2021, and I just sold it this year. So I'd held it for about 4 years, collected the dividends, made a lot of money from it, and decided to move on because I had made a lot, and I really wanted to get into tech stocks while they were crashing as much as they were. And I got out at around 19, so I got out at a good time, I think. But moving on to the actual DCF analysis, so we can kind of get into the fundamentals of the business. Here we have the weighted average cost of capital for Energy Transfer. I got 5.58%. I did this by calculating the cost of debt after tax and the cost of equity, and then multiplying each of these percentages by their cost mix to get an average of 5.58%. I then use that here as my discount rate, a perpetual growth rate of 2.5%. We can see here that on average since 2021, the revenue growth of Energy Transfer has been 6.3%. We could see that the trailing 12-month number is pretty much flat with the 2024 number in terms of revenue. The cash flows are greatly decreased. I'm guessing that's because they're having to pay back some kind of debts or do something with their cash flow that's intelligent. But we could see that the cash flow is not necessarily getting better, and I think that that's really the tariffs having an effect on this company, and Canada really lashing out at them. I think that it might be time to buy, though, if you have a long-term perspective, because I think that there is definitely a lot of value to be realized here. And you also have to kind of think about this business in a different way, too. It is very inflation proof, because whatever you're paying on the debt and whatever you paid to put those pipes in the ground, that's what you're going to pay. You're not going to have to pay more because this certain material costs more, unless, of course, it depreciates down, but that's a whole different discussion. I think that overall this business is very strong and you're getting kind of a good side of your bet, but I don't necessarily think it's the most attractive thing in the market right now compared to some of the other stocks that I've been buying. So I would not want to build a position in Energy Transfer. I kind of think that there are some more surefire stocks that are more likely to make money, and I've already exited from this stock. So I did think it was an excellent buy when I had it. I still think that it's probably a very strong value play, especially when you consider the 7.56% yield. I think that a yield is going to be more valuable into the future, but I'm not sure if that dividend is very secure, especially when we look back at that weighted average cost of capital. We can see that the debt is worth more than the total market cap of the business, and I don't really necessarily love businesses that are that debt weighted personally. I would much rather have maybe an index of these types of companies, or maybe an Enderbridge or a Kinder Morgan or something like that. I think that Energy Transfer isn't necessarily in the best shape because they've been paying such a high dividend back, and I think that they've really been targeted by these tariffs. So I'm personally going to avoid it, but I can show you that even if they have a 0% growth rate, you can see that there's 66.26% upside in the stock. So it really is kind of a very high risk, high reward play here. And if you're someone who really believes that these tariffs are going to kind of go away, I think that's kind of the bet that you could be making on the short to medium term on this stock. But I think that it's more likely that we're going to see continued escalation by this current administration and the Canadians. It doesn't seem like we're going to come to a very happy or healthy resolution on this. So I think that Energy Transfer is going to continue to drop. And I actually think that you can get this cheaper, but I don't actually think that this is a bad price necessarily. I just don't think that I want to buy this just because of the inherent risks and all of the little, things that can go wrong with this. There's too many red flags for me, and I like to invest a lot more safer. So I don't think I would want to put any money into Energy Transfer personally. Let me know what you guys think in the comments section down below. I'm always interested to hear your guys' opinions. I tried to do this one as efficiently as I could, and I hope you enjoy the finished video. Thank you. Bye.